Hello and welcome to Portfolio Matters, week 111. But before we get into it, Stuart Owen will read the disclaimer.
Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
Thank you, Stuart. Right, first of all, the news this week. Well, Silicon Valley Bank, which started the whole recent crisis in the financial world, has been taken over by First Citizens Bank, and they have acquired the deposits and the loan book, but they have left all the securities which caused the problems with the US government, who have incurred losses of about 20 billion, I believe. First Citizens shares shot through the roof, almost doubled. The International Criminal Court has ruled in favor of the Iraqi government in a dispute with Turkey over oil exports from Kurdistan, which bypassed Iraq and gave the money straight to the Kurdistan regional government. Turkey has been ordered to pay Iraq 1.5 billion for breaching a 1973 agreement that gave the Iraqi central government a veto on exports via the pipeline. And the pipeline has now been closed down, resulting in around 450,000 barrels of oil being taken out of the world market. I will be talking about that in my portfolio section. Elsewhere, Azerbaijani troops have entered Armenia, and while Russia is engaged in Ukraine, its sphere of influence is weakening. And finally, last night, Donald Trump was indicted in New York for hush money paid to a porn star. And there is no date set for the trial, but that's going to be interesting. Okay, some charts relating to the news. Well, this is First Citizens Bank, and its shares surged enormously after it's bought the rump of Silicon Valley Bank. So since the failure of Silicon Valley Bank, interest rate expectations for the second half of the year have absolutely collapsed, and the FANGs have done very well. Now, we'll show you some charts later showing that actually the S&P 500 as a whole is not having a very good year, but the FANGs are holding the whole thing up. Now, the big fear is that the crisis in the banks leads to a credit crunch. And this chart is a forecast. Now, the big question is, are those forecasts correct? If the forecast credit crunch occurs, then you can expect to see slowing economic growth in the second half, and our forecast of a recession in H2 becomes near certainty. But so far, the numbers we're seeing show very little evidence of a credit crunch. Elsewhere, reminder that the US has hit its debt ceiling. And we showed you a chart last week showing that the money in the US government's bank account, the Treasury General account, is rapidly running down. Well, the credit default swaps on US government bonds continue to rise. So the market is worried about the possibility for a US default later in the year. Things seem to have calmed down in the markets, particularly in the equity markets. And the light blue line is VIX, and the dark blue line is the MOVE index, which measures volatility in the bond market. And what's been very surprising is the difference in reaction between the bond market and the equity market. The equity market has had a very good week, whereas the bond market continues to expect a recession in the second half and a cut in interest rates, and the both can't be right. If the bond market's correct and we're going to see a recession in the second half, well, that's very bad for corporate earnings. And you should see equities falling. But they haven't been. They've been rising this week.
It doesn't, I think, change your overall point, but I think a lot of people have been curious about why the VIX has been so low in general over the past 6 months or so. And I heard an interesting explanation the other day, which is that it's so low because we're looking and measuring daily volatility, close to close. And if you adjust that and you look at intraday volatility, it's actually been much higher. And that might be connected to all these sort of 1 day and 0 day options that are being traded.
Yeah.
Because what happens with them is if someone buys a call option beginning of the day, and if it's working out, they sell it at the end of the day. So you tend to get a sort of compression of whatever direction there has been. It compresses back the other way at the end of the day. But within the day, you do get volatility.
Interesting. Okay, thanks, Stuart. Okay, on to this week's economic data. And there was a bit less of it this week. So this morning we have had UK house prices, and they missed expectations. They fell 3.3% year on year against expectations of minus 2.2%. So the falls in UK house prices are accelerating. UK retail sales in February beat expectations, expected at plus 0.2, came in at plus 1.2%. So in February, at least, the UK consumer was showing resilience. Now, we've also had the PMIs for the UK, Europe, and the US. Now, in the UK, they're disappointing. So the UK manufacturing PMI was expected at 49.8, came in at 48 in March. Services was expected at 53, came in slightly below that, 52.8. So still in expansion territory, but fading from February, weaker than February. And the composite also weaker than February. Now, UK consumer credit in February beat expectations, but was down on January. And if you look at the numbers, it's all due to mortgage lending. So mortgage lending absolutely collapsed in February. It was expected at 2.4 billion. It came in at 0.74 billion, way below January and consistent with falling house prices. So rising interest rates are really putting off UK house buyers. But all that said, in February, mortgage approvals actually bounced and beat expectations. So that suggests stronger mortgage lending in the coming months. Okay, moving on to the EU, we had manufacturing PMI, which continued to weaken, expected at 49, fell deeper into contraction territory at 47.1 in March. But if you look at the service sector, services were really strong. So service PMI beat expectations by a decent margin, coming in at 55.6. So the composite also beat expectations. So everywhere we're seeing manufacturing weakness, but service strength. We also then had the ECB's survey of European consumers, and that showed that their inflation expectations were actually worsening again, sadly. Consumer confidence was poor, but not deteriorating. Industrial confidence missed expectations, which is in line with the PMIs. Services confidence actually faded in March from February, and that was against expectations. So the expectations was that would strengthen, it weakened. And looking at the US, we had durable goods orders for February, and they missed expectations. They're expected to rise. They fell. The PMIs for manufacturing actually beat expectations, unlike in the UK and Europe. So in March, it came in at 49.3, still in contraction, but better than February and up on expectations. Services also did well, beating expectations by a decent margin and up on February, as was the composite. But Dallas Fed manufacturing index shows that March was much worse than February and down on expectations. We also had some quarterly numbers for Q4 last year, but frankly, I think they're rather out of date now. If you're interested, pause, take a look. Stuart, some charts.
Okay, so this is the net lending statistics in the UK, where we can see the impact of that sharp decline in mortgage lending. So very weak overall lending to individuals. And here's that data on mortgage lending. It really puts the weak number in context. It's from this chart, it's not too different from zero.
Yeah.
Mortgage approvals, slight tick up, but I think that the bigger picture there is, of course, very weak mortgage approvals. Very difficult to see people being that motivated to move house, given the interest rates that people are facing now.
Yeah.
Consumer credit, not too bad. That's looking perfectly reasonable. If you think consumer credit is a good thing, I know we've had this debate with US credit card numbers about whether actually a higher number is a sign of animal spirits and spending, or whether it's a sign of desperation. Consumer confidence bouncing off some very weak numbers, so going from very awful to just awful. And the retail sales month on month, surprisingly good. People still spending, 1.2% up month on month, and that's after another positive month in January. Year on year, presumably this is in value terms, it's still negative, presumably the effect of inflation there. And that's now been negative, coming up for, well, what's that, about 10 months or something? So that must be grindingly difficult for retailers. The nationwide house price, I don't think that's year over year. I think that must be...
Oh, yes, sorry, you're right.
That must be a nominal house price.
Yeah.
And of course, I think this will cause different generational impacts. I think a lot of young people would welcome this.
Absolutely.
Looking at the UK global manufacturing PMI, a bit below 50, weak but not awful. Services, pretty strong, perhaps reflecting those retail sales numbers, but not as awful as you might think. So therefore, the composite, which I'm assuming is more heavily weighted to services than manufacturing, also not too bad.
Yeah. I mean, in the context of history, pre-pandemic, that's a decent number.
Looking at the European PMIs, here's the European manufacturing data. Looking unsurprisingly weak. I think the main surprise have been so strong at the back end of... Oh no, I'm getting the dates wrong. That's 2022. Continuing a weak performance there. And European services, as we've seen in the UK and in the States, pretty robust. So I don't know whether this is a distributional thing where those with money are spending it. I know you referred to this before, Keith, as sort of dry powder in people's pockets. People, I don't know what counts as services, but you would imagine holidays, flights, hotels, haircuts, and therefore the composite for Europe, not too bad at all. Yeah,
it's really surprising, the strength of services. And, we have been forecasting recession in the second half for quite a long time now. But if you look at the data, the leading indicators are all forecasting weakening economy, but the contemporaneous hard data is showing actually resilience and economy's doing all right.
Consumer inflation expectations, not sure quite how this is calculated. I'm presumably a net balance of whether inflation is going to go up or down.
Yeah.
At only plus 20 is actually not too bad at all. Certainly nothing like the plus 60 that there was about a year ago. Consumer confidence, as is often pointed out, this is never positive. Europe is always miserable, but from having been very, very miserable, it's now very miserable. Perhaps one day we'll see that hitting the highs of -5, but for the moment it's about -18.
Yes. Well, there are riots in Paris. So,
Industrial sentiment in Europe, flat. Presumably, there must be at least some positive impact from reduced energy prices. Services sentiment, yeah, not too bad, reflecting the PMIs there. Turning to the US, here's durable goods orders. And I think as we're seeing a pattern across the world where goods and manufacturing is weak, services is strong, and this is a good example of that. So down 1% month on month after 5% fall in January, so sequentially pretty painful. The US manufacturing PMI, actually, as Keith pointed out, it's only fractionally in contraction territory, but still slightly shrinking. Services, yeah, again, it's the picture we keep talking about, surprising resilience in services across the world. And therefore, the composite also pretty strong. And the Dallas Fed Manufacturing Index showing that weakness again, coming in at levels that previously have been pretty weak. If you exclude the pandemic spike, this is a pretty weak number. The Richmond Fed Manufacturing Index, not quite as bad, still shrinking, though not quite at the rate seen in previous surveys. The US Case-Shiller house price year on year is fast approaching zero. Obviously, this is slightly lagging. It's very high quality data because it looks at the sale of exactly the same properties only, and therefore it takes a little while for all that data to come through, but not looking good as forecast really, and totally as expected given the increase in interest rates. And if you look at that on the month-on-month basis, as Keith is showing here, we've now had 7 months in a row of falling house prices. And the Johnson Redbook retail sales year on year, again, I think this must be in value terms, not volume, coming in at about 3%. So if inflation is, 6, 7, 8, then that must be, again, very, very painful for retailers.
Yeah, and it's drifting off steadily.
US 30-year mortgage rate bouncing around between 6 and 7%, about 6.5% at the moment. The mortgage market index, measure of pain, pretty much the same story as we've been talking for the past few weeks and months, showing mortgages are pretty painful to take out at the moment, totally unsurprising. Mortgage purchase index, same story, a bit of a bounce. Not quite sure why that is. I suppose mortgage rates have come off a little bit, but within the context of the volatility of the series, I think the bigger picture is just weakness. US initial jobless claims picked up a bit, no real breakout, totally within the normal volatility. But if you're minded to think that a recession is coming, you might look at that number and see it as a harbinger.
Yeah, I wonder if there's quite strong seasonality in this chart, because you see that last April we started to get a big rise into the summer and then it fell again. So I wonder if that's the case again.
Continuing jobless claims, really no change, coming in at about just under 1.7 million annualized, which has been at that sort of level for quite a while. US financial conditions are tightening, but not that tight. Not sure quite how this is calculated. Keith, do you have any idea?
Which is Chicago Fed, and you can see the various components on the bottom here. Now, I don't know how they measure it, but I suspect this is all from market data. What you really want to know is, are the banks lending? And I think what this measures is things such as CDS spreads, etc. So market-based data. And as various people have pointed out, that basically means it's more a measure of risk appetite and the market's risk appetite than it is of lending conditions.
So in summary, the service PMIs in US and Europe continue to look surprisingly strong. As Keith said, a lot of the contemporaneous data is not bad at all. By contrast, manufacturing PMIs are weak everywhere. In the UK, the housing market outlook looks very poor. Mortgage lending is down heavily. UK retail sales are showing surprising resilience, however. And in the US, there's a slow burn. fall in US house prices. So bottom line, March PMIs show a surprisingly decent economy.
Thanks, Jude. Okay, on to one chart. And when we're talking about banks, this is the price to book ratio of banks since 1998, when, if you remember, the banking industry lobbied to get Glass-Steagall repealed. When Glass-Steagall was the US legislation set up after the Great Depression, which enforced a separation between investment banks and retail banks to stop banks from gambling with their customers' money on the stock market. And the point is that since then, you've created these mega banks, which have proved difficult to manage. And so market trust in them has fallen sharply. So having traded at a premium to book value, they now don't. And the European banks now trade at a decent discount to book value. And the commentary to this piece was that a lot of CEOs now recognize that the repeal of Glass-Steagall had been a mistake, and that some form of legislation enforcing a separation of risk between the investment banks and the retail banks was now recognized as a good idea. In a change this week, we're going to start off with Financial Crisis Watch. Okay, so what's going on? Well, the market is worried about the banking system. It's worried about unrealized losses on securities and bonds bought by the banks and in the US held on their held to maturity portfolio, where it's not marked to market, as opposed to its at for sale portfolio where it is. So US banks are holding enormous unrealized losses. They're also holding losses on their loan portfolios because they made loans during the pandemic at very low interest rates. And if they were to recognize the value of those loans as they are now at higher interest rates, that would mean also taking losses. And they're also heavily exposed to commercial real estate, and changes in working patterns have meant that people are using the office much less, rents are falling, and therefore the value of those properties is falling. And when those properties come up for refinancing, then the market is worried that the banks may actually end up holding the keys. We've also had deposit flight from the small banks in the US to the big banks and to money market funds, which yield vastly more than the 0.5% on offer in the average US bank. And because the market is concerned about the failure of banks, you've seen credit default swaps and funding costs for all banks rising, and that places further stresses on their profitability. American banks are estimated to have losses of $620 billion on their bond portfolios, of which $341 billion is in their hold to maturity portfolios and has not been accounted for. In contrast, UK and European banks are in much better shape and have accounted for the majority of their losses. So one of the messages of this is going to be that the problems are concentrated in US small and medium banks. You can see from this chart, the losses are a direct result of rapidly rising interest rates. And throughout the past year, we've been warning that rapidly rising interest rates place a great deal of stress on a heavily indebted world economy, and something was going to break. Well, we've found out that one of the areas that has broken is US small banks, because the yield on the average deposit account is much lower than the yield available on government bonds. In the US, for example, the average interest rate on deposit accounts is about 0.5%, whereas you can get 4.75% plus in a money market fund investing in US Treasuries. So rationally, investors are taking their money out and putting them in money market funds.
Yeah, it's really asymmetric, isn't it? I mean, it's in the interest of the overall system if people leave their deposits there. But the upside, if you do, is very little, and the downside is possibly awful.
Yes.
So you're bound to, irrespective of earning a higher interest rate. Now, wasn't it Mervyn King who himself said you'd be mad to start a bank run, but you'd be mad not to join one once it had happened? And this is the sort of problem that we're facing.
Yeah. Now, when we talk about the funding costs, when Credit Suisse went bust or was taken over by UBS for a pittance, the Swiss regulator zeroed the AT1s. Now, we have a section on AT1s coming up later, but AT1s are in between equities and bonds, and they're part of the capital structure, and they're meant to be senior to equities. Now, what the Swiss did was they wiped out the AT1s without wiping out shareholders, so upending the capital structure. And that has very much upset AT1 investors. So the yield on AT1s has increased, and that means it's more expensive for banks to refinance their AT1s. So their funding costs have risen.
Main thing which surprised me about that chart was still the actual I see it's the spread over treasuries. It isn't the actual yield. Okay, yeah. Got it. Because it looked like 5% on an investment grade cocoa didn't actually seem that high, but that's on top of say a 4% treasury yield.
Yes, that's starting to get quite expensive. And this is the credit default swaps on various European banks. Now, if you look at Deutsche, most of the concern is around Deutsche Bank, but we've also had sharp rise in Barclays and UBS. But talking about Deutsche Bank is in much better shape than it was during the Great Financial Crisis. If you look at its liquidity coverage ratio, it is below the European average, but well above the US average. And I thought this was really interesting. It has massively slashed its exposure to derivatives. And that was one of the big concerns about Deutsche Bank, that it had enormous and opaque derivatives exposure, but it's really cut it. It now has substantially less derivatives exposure than Barclays.
Well, was this the function of a big netting effort that the regulators put on the banks? These are massive reductions, aren't they? 70 trillion down to 15 trillion. But this has also, I think, got an interaction with what the Swiss authorities did with Credit Suisse, because obviously there's been a huge argument about what the Swiss authorities did with the AT1 bonds. But one explanation I heard was that actually they didn't want the equity to go to literally zero, because that would have had massive consequences for all the derivatives that Credit Suisse had signed, because they would basically, the counterparty would be bankrupt. And you could imagine the cascade through markets if all the derivative contracts were suddenly invalid or couldn't be settled. So I think there was some pressure to make sure that equity was officially not bankrupt to preserve all the derivative contracts.
Very interesting. When you look at the commercial real estate exposure of Deutsche Bank, so US commercial real estate, you see it does have some, but it's really not very exposed. It's got 35% of its capital exposed to US real estate, which seems manageable and is much less than some other smaller banks, although it is high by the standards of the major European banks. And it's got plenty of liquidity. So the share price has fallen by, what's that, about 25% since the failure of Credit Suisse, and has recovered a bit in recent days, but the market is still concerned. So the share price has not recovered to anywhere near where it was pre Credit Suisse. So in summary, for Deutsche Bank, where the market seems most concerned out of all the European banks, it is in much better shape than it was pre-Great Financial Crisis. In particular, its derivatives exposure has been cut drastically. It was about 75%. And it seems to have plenty of liquidity. Now, any bank can fold if there is sufficient crisis of confidence. But really, it doesn't appear that there is that much reason to be worrying about Deutsche on fundamental reasons. Stuart, do you have anything?
Well, this is the issue, isn't it? That so much of this is about confidence. We were speaking offline about the analogy with COVID toilet paper, that if we all keep our heads and just go about our business, all is fine. But if I suspect you're rushing to the shop to buy the toilet paper, well, I'm going to rush in ahead of you. And you create a problem where one didn't need to occur. And that's why I find this quite a difficult subject, because if you look at the fundamentals, everything looks bearable. But it's just one of these issues of a cascade risk where that one snowflake additional to a snowball rolling down a hill creates an avalanche. We saw this with the US banks, didn't we? That this was supposed to be a medium-sized bank that didn't fall under the Fed's regulatory coverage, and because it was small enough that it could fail. But even a modest-sized bank wasn't allowed to fail because the cascading consequences were just so horrific.
Yeah.
So the regulators come in, and we know that they're going to provide whatever liquidity is necessary to stop that sort of cascade. So it shouldn't happen, but something can come out of a medium-sized bank, or possibly even a small bank somewhere, which is impossible to predict.
And the fears in the market are spreading to all financial institutions. So this is the credit default swap on Lincoln Financial, which is an insurer in the US. So insurers are also seeing their funding costs rise because of their exposure to commercial real estate. And this is the share price of First Republic Bank, which is also the subject of speculation that it could be the next domino to fall. And you'll see its share price has fallen a long way and is not recovering. So although equity markets have recovered strongly, this crisis is not going away. It's ticking away in the background.
If you think about it, who would now place a deposit with First Republic Bank? It's back to this total asymmetry. You're going to get nothing and you're going to take risks. So why would you do it?
Yeah,
the
absolutely.
deposit base is going to be eviscerated. So the solution would normally be take over by JP Morgan, who can absorb it all. No one's got any doubts about their capital position and their liquidity. But JP Morgan, for instance, would never do something like that because they got so burned by bailing out Bear Stearns and subsequently being legally liable for all the shenanigans Bear Stearns had been up to. So Jamie Dimon has been totally clear. He's not going to bail out or not going to acquire any sort of medium-sized or smaller bank because he doesn't want to be subject to these sort of the punishments that would be meted out for the failures of the acquired bank.
Yeah. I think one of the lessons of the Great Financial Crisis was that a lot of these takeovers, the acquirer came to really regret their purchase because they didn't know what was actually in the books. And this is the regional bank ETF for US. And again, it's not recovering. So there is a lack of confidence in US small and medium banks. And CMBS prices have fallen, although not much, actually. They are towards their lows. And now I don't have access to live prices, but this is the ETF. And it's not even at its lows of 2022. So there's doesn't seem to be that much stress in commercial mortgage-backed securities. The corporate bond ETF is showing very little signs of stress.
I was listening to a podcast about an issue which I think you have raised in previous Portfolio Matters weeklies, which is about sort of central bank liquidity driving or being a almost completely explanatory factor for the S&P 500.
Yeah.
And the guy on the podcast was making the case that actually we need to look a lot further than the Fed. We need to look at the BOJ and the Central Bank of China as also, in effect, still being in QE mode. So his argument is that you're getting a cascade through markets where liquidity is being provided very cheaply, and that is leading to, for instance, still surprisingly low spreads on high yield bonds. And there's the whole culture of risk taking actually remains surprisingly in place.
Yeah. Well, I will update that chart next week, Stuart, but you're absolutely right. The Fed's balance sheet is rising again. Is it any coincidence the NASDAQ has had a really good couple of weeks?
Absolutely. Yeah.
And the FRA OIS spread, which reflects how much banks are charging to lend to each other and therefore the confidence between banks, is elevated, but actually not as elevated as it was last year. So that's not particularly high. And if we look at it on a very long-term time scale, currently it's 33.8. During the Great Financial Crisis, it got to 175 plus. So not really that much stress. And so when you look at the current market situation, there has been a rise in the finance costs of Deutsche Bank and other financial institutions, and the share prices of banks have all suffered and not coming back. So within the financial system, you are seeing some stress, but we're not seeing any signs of that stress really spreading outside the financial system to the wider economy. And the market is anticipating that it does. So the bond market in particular, is saying that it expects a credit crunch in the second half to lead to slowing economic growth and cuts in the federal fund rates as soon as July. And I just don't see it. At the moment, where there's no evidence that the stress in the financial sector is actually causing problems for the wider economy. Stuart?
Well, you're right, aren't you? We're sort of in that suspended moment, waiting to see if anything further comes out. If it doesn't, then we can expect growing confidence that we've got through this and that the patch has been effective, and actually the fundamentals weren't that risky in the first place. But these are huge numbers when you look at bank balance sheets, huge numbers of assets and liabilities, and the equity is the small difference between the two. So I think we have to also be somewhat humble and recognize that these are very complex institutions and that they're all interrelated. And I know Richard would say it's a complex dynamic system where something could tip over. So, reason says, no, we're okay, we should be able to muddle through. But there is that fear still at the back of my mind.
Yeah, I mean, the thing is, I think that the US small and regional banks, who are responsible for a large amount of credit provision, particularly to the property sector, this shock can't increase their lending. It can only decrease it. So there will be a contraction in credit. But the market seems to be making very strong assumptions about the size of that contraction, for which we just have no evidence as yet. And on your point, we don't know. So we're just going to have to wait and see what the numbers are.
But does this make you think that the rally in bonds or shorter bonds is actually overdone, that we're not going to get the cuts that the market is expecting?
It does, Stuart. And on Monday, I cut my bond bet.
Well, we'll get into that, I'm sure.
Yeah, we'll get into that. So the reason that the share prices of insurers, etc., are suffering and their credit default swap prices are rising is that the market is concerned about the commercial real estate sector in the US. So the fear is that small US banks own about 70% of commercial real estate loans, and office vacancy rates have been rising in the US as changing work patterns mean that people don't go to the office as much and less office space is required. Therefore, rents have been falling. And actually, I found this was an amazing chart. So the dark blue bars are office space being built, and the light tan colored bars are office space actually being occupied. And you'll see that the industry has continued to build office space despite actually big drops in occupation. And in the last few years, a lot's been built, almost none of it appears to have been occupied.
I think that there's a really important sort of distributional effect here, which is that these offices will be occupied. It's the grade B and grade C offices that will be eviscerated. And in particular, in the UK, that's an issue because of the environmental standards that are being required of offices. So a newly built office which meets those standards has got a reasonable hope of being occupied. But it's the retrofitting costs on the older offices which are going to kill them. And any lending to that area of the market, I think, is the particularly weak area.
Very good point. If you break down maturing, so loans that are maturing in the next few years by who provided those loans, you see that actually local and regional banks, which is light blue, is not the main cause of concern. CMBS, commercial mortgage-backed securities, there's a lot of that maturing this year. And of the commercial real estate loans that are maturing over the next couple of years, around 23% of that is offices. Now, that means of the 50 billion held by small and regional banks, only about 11.5 billion is in the problem office space. But another cause of concern is that commercial property is trading at a big premium on a yield basis to treasuries and appears overvalued compared to rents, and those prices should come down. And they have started to fall, but on the ratio to treasuries, they've got a lot further to fall. And this chart shows the increase in rents year on year. And you see the problems, the light blue line. Offices have no pricing power.
I'm amazed it's above zero, to be honest.
So since the failure of Silicon Valley Bank, the whole financing industry appears to have ground to a halt. So no new junk bond sales have been done in the last couple of weeks. And this is actually in the UK. Pause and take a look. But when these commercial real estate loans are coming up for refinancing, then you're finding out that borrowers are simply walking away and handing back the keys, and the lender then has to try and sell the property to recoup their loan. In this case, Lloyd's is trying to recoup a loan of 175 million, which it made against a property that I believe was originally valued at 410 million. So that seemed to give them a very good cushion, but that loan has now been defaulted on, and that property, which was valued at 410, they're now trying to sell for 250. And the commentary is that that's going to be difficult to achieve. And this is what the market's worried about. So in summary, commercial real estate is overvalued. There's roughly around 500 billion of commercial real estate loans that are coming up for refinancing every year for the next 5 years. However, most of those loans were made 5 to 10 years ago when prices were much lower. We're talking about in the US now. Loan to value ratios are not particularly stretched, and CMBS are more exposed than the banks. Offices are a problem, but JP Morgan have done the work, and they don't think that failures in the office market alone are enough to cause significant stress to small regional banks in the US. They think this will be an earnings event, not a capital event. And much will depend on the distribution of those loans. So I'm sure that some banks will get into trouble, but overall, the banking industry should be able to survive. What are the knock-on effects of that? Well, credit conditions for US consumers were already tightening, but we've seen that actually the consumer has been doing all right in the US recently. Retail sales have been surprising to the upside. Credit conditions for US small businesses also were tightening. None of this data has been updated post the failure of Silicon Valley Bank. But again, this isn't particularly bad. Corporate credit spreads, not that bad, frankly, compared to the great financial crisis, or actually just mid last year. Small banks have been borrowing from the Fed in record amounts. And reminder, they are then replacing deposits, funding from deposits, with funding from the Fed at much higher interest rates. And that will eat away at their profitability. And larger US banks have also been borrowing, which means the Fed has been pumping enormous amounts of liquidity into the financial system. So comparable rates to during the great financial crisis. And that's all because depositors have been fleeing. But when you look at it in context, the size of the flight so far is not that huge. And as we talked earlier, the flight has been out of commercial banks into money market funds, which yield vastly more. And frankly, you should expect, we expect this to continue simply because it's the rational thing to do. That all said, all the evidence so far is that despite the outflow of deposits from large and small US banks, loan growth appears to have been unaffected. So the black line is loans. Even as deposits have fallen, the banks have continued to loan. Now, we've featured this chart a few times now, showing tightening lending standards, but credit is still flowing into the US economy. And this chart shows that when banks start to borrow from the discount window, that raises their funding costs and they tend to tighten credit conditions. Now, we're expecting that to happen. The question is to what extent. The flight of deposits has meant that a lot of the excess liquidity pumped into the banking system during the pandemic has now been unwound. But regional banks, so far, they've been solidly profitable. You see they've upped their cash holdings. So they've got plenty of liquidity, thanks to the Fed. And if they do start cutting back on their lending, that has big implications for the US property sector, because US small banks have been growing their lending book to real estate by an astonishing, actually best part of 20% over the last year. So we have been wondering about the continued strength of the construction sector in the US. If the banks start to cut off funding, that could finally start to fall, and that could initiate the recession. So in summary, small and medium banks in the US are a cause for concern because of deposit flight, their losses on their loan books, and their exposure to commercial real estate. But overall, it does not look like the industry is in that much trouble. If there's sustained deposit flight, then anything can happen. But based on their exposure to commercial real estate, that there's not enough to cause a crisis. They do have losses to realize on their loans and their securities, but if they can survive, they don't need to take those losses. Stuart, have you got any thoughts?
No, I think you've covered it very well, Keith. It's quite a complicated problem. And again, being level-headed, you would think there are problems, but they're manageable. But it's back to the snowball risk and the panic risk. But if we can keep our heads, then it looks like, well, how did you say it before? JP Morgan said it was an earnings event, not a capital event. And
yes,
that would seem to be the neutral, rational expectation.
So the bottom line is that credit conditions have tightened for banks and financial institutions, but as yet, we're really not seeing any evidence of it in the wider economy. And frankly, we have been reporting for a while now that banks are tightening lending standards, but the economy seems to be doing just fine, thank you very much. So I am going to wait to see evidence of tightening credit conditions and a reduction in credit availability before I start reacting to this. This is my mental model of how I think events will play out. And this is very much a result of my experience, particularly since during the Great Financial Crisis, but from 35 years in the market. And so this chart has 3 lines. The red bars are crises. The dashed blue line are financial conditions, and the green line is market sentiment as measured by, for example, the stock market. Now, the initial red line is the first crisis, and what happens when underlying conditions are deteriorating and the first most exposed corporations go bust. So in this case, it would be Silicon Valley Bank and Credit Suisse. During the Great Financial Crisis, it would be Bear Stearns. Now, the market reacts very negatively to that and sells off hard. But the point is, the market can't stay very bearish in panic mode unless there is continued flow of bad news. And as the bad news dries up, the market recovers strongly on the assumption that everything is contained. And remember, during the Great Financial Crisis, there was loads of bad news, and it was quite obvious that the underlying issues were not resolved, but the market recovered quite well throughout the whole of 2007 and into early 2008. But the underlying conditions continue to deteriorate because there's been a shock caused by the initial crisis, and the causes of that initial crisis continue to deteriorate. So underlying all this, later on, you get a secondary crisis as those problems have not gone away and the additional financial stress leads to further failures. And it's only after that you get a big market sell-off and a crisis. Stuart, your thoughts?
Yes, that is so true in the Great Financial Crisis, wasn't it? That initial shock, but then, oh no, things can go back to normal, and we all want to sort of mark back to how things have previously been. But actually, underneath that, reality is gradually grinding away. And I think this is also can be true in individual stock cases as well, where we try to mean revert. We try to assume that things are going to go back to how they were, but actually there's a second shoe is coming to drop a bit later, and that's when everyone loses confidence, and that's when, of course, that's the blood on the streets time, when you have to have the cash around to buy and the fortitude to do it.
Yes, absolutely. And on your point, actually, so I think one of the reasons that there's recovery is everyone has an incentive to try and portray the problems as fixed, as containable. But underlying the behavior, the people's incentives are very much to take their money out of the small and regional banks. And so I think you're just going to see this steady drip, drip, drip of deposit outflows causing stress, which then means those banks have to take money from the Fed at much higher interest rates, causing an erosion of their profitability. And then throughout the year, you're going to have this steady refinancing of loans and commercial real estate loans in particular, which will precipitate losses. Something I fully expect more bank failures later in the year. This is a survey of market participants, and the general expectation is that it can be muddled through. And I think that's probably about right.
Yes, very good, Keith.
Okay, on to inflation watch, Stuart.
Okay, here we go. So UK CPI 10.4%, RPI 13.8%. But I think the main news this week has really been in Europe, where I know Spain came out with a very low CPI number. I think it was even 4%, which is very low. I think they had a cap on energy prices, which has caused the numbers to be so much less there than elsewhere. By contrast, Germany is 7.4%, so inflation peaking there, but hasn't fallen as much as the market had been hoping. Right, here's something tangible, the cost of some foods. Here we go. So cheddar cheese in February 23, £3.69 for 400 grams of cheddar cheese, which is up 49% on a year. Milk up 43%, sugar 31%, eggs 29%. I'm surprised it's that modest. I thought there'd been a global egg crisis. And sliced white bread up 21%. So very tangible numbers that we see every day. Normally we talk about petrol and gas prices as being the visible ones, but this is what people are seeing day to day, some very painful increases. Now that was data to the end of February, but unfortunately the numbers are not getting any better. Here's some data to the end of March, where with regular overall CPI approaching 10%, by contrast, food is at 15%, and within that, fresh food is looking more like 17, 18%. So this is to do with bad weather in the south of Europe and Africa, and the impact of higher energy prices. So no respite at all in the food area. Contrary to Keith's expectations, this isn't just a sort of a downbeat story about the UK, it's across Europe. So the left-hand column here is showing food inflation across various countries in Europe. So Germany, about 22%, Portugal, 21%, etc., etc. But you get the picture. It's not just the UK. It's a general problem across Europe.
Yeah, I had thought that this was Brexit problems with, importing the additional bureaucracy, putting off importers. But thank you to our Discord member, Dodkins, for pointing out that my prejudices are wrong.
And so this is German food inflation year on year. My goodness, that's painful, isn't it? 22.3% on this measure. So presumably even Lidl and Aldi are having to increase their prices.
Well, I found this really amazing, given that German headline inflation fell from 8.7% in February to 7.4% in March. But food inflation kept on rising. So other components must have slowed quite substantially.
And talking of which, here is the overall CPI inflation. So as Keith said, down from 8.7% in February to 7.4% in March, not falling quite as much as people had hoped. Dutch CPI inflation down to 4.4%, a very sharp fall. Core CPI apparently was still flat at 6.7%, so presumably a very big energy effect here.
Yeah. Everywhere we're seeing service inflation continuing to be strong.
Dallas Fed manufacturing survey showing prices falling fast in that area of the economy. Again, this picture of services good, manufacturing and goods weak. US import prices year on year are now apparently falling, which again suggests it's all part of the same story, I think, of physical goods and manufactured items. I'm not quite sure how to, this was a very surprising chart to me. Economists are forecasting core PCE inflation of 4%, that they seem to be rather lagging in their predictions, which seem to have evolved from the traditional 2%, only very slowly up to 4%.
Yeah, just when we think inflation's peaking, they're continuing to raise their expectations.
Changes in US rents. This surprised me again. I thought that rents in the US had been falling, which they had been, but that seems to have reversed and been picking up for the past couple of months.
Yeah, absolutely. Will worry the Fed.
And oil has a big impact on CPI inflation, which I think we know, hence why there's often a focus on core rather than headline inflation. But given what's happened to WTI and Brent oil prices, i.e. they've been pretty weak over the past few months, that can be expected to bring down the CPI measure of inflation. So in summary, food inflation is high and continues to rise. Spanish and German inflation has fallen in March, so hopefully that's presaging better inflation data elsewhere, though, however, there was evidence of service sector inflation. That, I think, is the picture that we keep coming out with in terms of both activity and prices. Services activity not too bad, and inflation, whereas goods is the other way around.
Yeah. Okay, thanks, Stuart. On to recession watch. Now, recently, the soft economic data has bounced. So look at small business optimism in the US, which is the red line, and CEO confidence. It has bounced back, but it remains negative, whereas the house builders, their confidence continues to fall. But when you look at the actual data, the hard data, then we're seeing economic surprises to the upside, which continue. And so we're just seeing no evidence that the weak leading indicators are leading to actual weakness in the hard data. So this is the Citigroup Economic Surprise Index hitting new highs. But is that changing? So this is Bank of America card spending, and you'll see that it has been declining, and actually it has gone negative year on year in the last few weeks. So is the anticipated weakness in the US consumer spending finally happening? And elsewhere, so this is the Bureau of Economic Analysis, and their data also shows a sharp fall in credit card spending in March. So it's going to be interesting to see how this develops over the next few weeks. In the UK, the red line is the volume of retail sales, and the blue line is the value, and you'll see the effect of inflation. So in real terms, retail sales are down year on year. Now, the big question is credit going to contract? And this is for the Eurozone. You'll see the brown line shows that bank loans to non-financial corporations were already negative year on year before the failure of Credit Suisse. And loans to households were positive but falling fast. Watch this space. Now, we've been surprised by the resilience of the jobs market in the US, but you notice that now CEOs are mentioning job cuts more than they're talking about labor shortages. So is that about to change? And economists continue to forecast a recession in the second half of this year. And Bloomberg economists put the probability of a recession in Q3 at 100%, which seems a bit over certain. I mean, we've been forecasting this for a while and we've been wrong so far. There's little evidence of it. But if you look at the Bloomberg Economic Surprise Index and split it into components, you'll see actually the main surprise index is not doing very well. What is causing the surprises is housing and real estate. In contradiction to the earlier chart, which showing that the economists expecting a recession in H2, well, their forecasts for overall GDP growth this year have been rising. So lots of contradictory data, frankly. We're seeing that credit card spending does seem to be falling in the US. So that is a warning sign. And corporations are announcing more job layoffs and talking about more job layoffs. A lot is going to depend on credit conditions. But bottom line is that the hard data is really not deteriorating very much, and the economic surprises continue to be to the upside. So we continue to expect a recession in H2, but so far it's more in expectation than in from signs in the hard data. Stuart.
Okay, so we're now going to have a little section talking about AT1s, which have been in the news a lot due to the events at Credit Suisse. So what are AT1s? Well, they are additional Tier 1 bonds, and they're part of the bank capital structure. They're often known as contingent convertibles or CoCos. So the idea is that at a time of stress, they can be converted from bonds into equities, or as we've just found out, they can be written down entirely to support the capital structure of a bank at a time of stress. So, of course, the issue is how do you determine the time of stress? So in many of the documents, there's certain trigger levels, numerical trigger levels related to the capital backing that the bank has. So the idea is that at time of stress, they can be converted and to support the bank's capital without there having to be a regular equity raise, you're just automatically converting this predetermined source of capital. So they're typically the riskiest and highest yielding bonds issued by a bank. So that's the idea, and they very much came out of the global financial crisis where regulators were trying to preempt future crises. So the diagram here shows the idea. The idea is that common core equity, so this is the value of shares issued plus retained earnings, is supposed to be supplemented by additional Tier 1 capital that we're going to talk about. And there's also another buffer of capital protection, Tier 2 as well. Now, the numbers that the regulators initially came out with were such that the common equity Tier 1 ratio of, well, that source of capital to risk-weighted assets was supposed to be greater than 4.5%. Now, in practice, banks have had much higher numbers than that. But that was reflective really of the conditions after the global financial crisis, where some of the banks going into that crisis had very, very low common equity to asset ratios. So the Basel III capital requirements is the big issue here. This is what's been driving the issue of AT1 securities. So it was established after the GFC. Now, the idea was that there would be a minimum capital requirement set at 8% of risk-weighted assets. So in all of this, we're talking about not the total assets that a bank has, but those assets with a risk weighting discount applied. So for instance, and totemically given the US banking crisis, government bonds, I think, are given a 0% weighting in the risk weighting schema. So we've got the common equity tier 1 ratio we just talked about, 4.5%, and then additional tier 1, which can be preference shares or these particular securities that are convertible with certain trigger mechanisms. And then beyond that, there's the tier 2, which are subsequent loss absorbing sources of capital. So how do they work? There's three basic features. As we've been talking about, they're really a loss absorbing mechanism. So if common equity falls below a certain trigger, typically that was either 5.125% or 7% ratio of common equity to risk-weighted assets, then the idea was that the AT1s would be converted into common equity, or they would be wiped out entirely, depending on the particular securities documentation. Now, the second feature is they're supposed to be perpetual, so that the regulators can be assured that they're a bit like equity. They're supposed to be permanent, always available as a source of capital. So they typically have no final maturity, but in practice, they are callable. And that's what's typically happened. After 5 or 10 years, the bank has called them. And what this has meant is that the regulators can look at them and see permanent capital, but what investors see is much more like a regular bond. And that, you could say, is leading the difference between fixed interest and equity. The regulators, in a sense, are seeing this as equity, but the investors are seeing it as bonds. And you could see the whole structure as a sort of workaround to give those two different constituencies the appearance of what they want to see. So the third characteristic of an AT1, beyond the fact that they're supposed to be loss absorbing and that they're supposed to be perpetual, is that the dividends or the coupon payments are non-cumulative and they are discretionary. So this means that a missed payment should not build up as an ongoing liability for a bank. The whole point is that these things are supposed to be a buffer which reduce the pressure on a bank's capital structure.
Yeah, and actually on the second point about AT1s being callable, what's happened in the last few days is that because of stresses in the AT1 market, some banks which had AT1s which they were going to call, they haven't called and they've just let them run. So that again shows one of the risks of AT1s. In stress, they become longer duration than you might have anticipated.
So what are the risks? Well, the risk, if you hold one of these, is obviously the presentation which we've just covered, which is that the bank's capital ratio deteriorates and you're converted from holding this, in effect, bond, you're converted into either nothing or into equity. Now, officially, as at the end of Q1 2022, the big European banks were actually all well capitalized, and they had a CET1 ratio of pretty much 15%. So looking at that, you would think, aha, no problem, 5.125%, 7%, miles off, no problem, nice big cushion. The second risk is that the bank may choose not to call the AT1s at the end of the non-call period. And so this is the risk of extension. And again, I would say this is also some sort of regulatory arbitrage where they're being presented as one thing to the regulator, i.e. permanent capital, but to investors, they're being presented as, oh, there's a regular bond, 5-10 year maturity, and we'll pay you back, even if technically we don't have to. The third risk is that the coupons can be halted by a regulator to preserve bank capital. And the fourth is that, of course, the bonds can be converted or they can be written off at the behest of the regulator rather than based on the accounting calculation of the capital ratios. Now, obviously, that has been a big issue for Credit Suisse. So European banks' CET1 ratios all look very good. So well, mostly good. I'm not sure the Barclays one looks that great. This is the gap to the AT1 trigger. But, if it's supposed to be triggered only at 5.125 or 7%, these are pretty chunky buffers, you would think. So the key issue is, in theory, the point of non-viability of the bank when the AT1 would be converted or cancelled. Now, if the bank gets into trouble, the regulators can declare a point of non-viability. Obviously, their main purpose, the regulators' main interest is to protect depositors, stem the losses, prevent contagion into the wider financial system. So European banks generally have, as we've just seen, very high CET1 ratios. So the issue is, how believable are those 7% or 5.125% ratios? Because there's a path to get down to that ratio. And I don't know how frequently it's calculated, but if it's calculated only on annual accounts, that's all going to be rather backward looking, whereas obviously markets are very forward looking and subject to behavioral and panic and psychological issues. So the issue that investors have now faced is that the regulator can make a judgment, a decision, a qualitative assessment that we've reached a point of non-viability, irrespective of what those capital ratios appear to promise.
Yes, very good point, Stuart. And that's exactly what happened to Credit Suisse.
Right. The market for these CoCos has actually been growing quite substantially. This is from 2013 of about 50 billion euros to about 250 billion in the past year or so. So pretty chunky. And again, as we keep saying, that if you believe the data on which these things were supposed to base their behavior, then there wasn't a problem. So we can look at the blue line here, which is the CET1 ratio, and then we can add in the Tier 1 capital, and then add in all capital. And you can see that the capital ratios are way above was it 8% that
8%.
Basel III required? So on even on CET1 ratio, about 15%, total capital ratio about 19%. So the question becomes, well, do these ratios really matter if, in fact, the trigger event is not a mechanically calculated quantitative ratio, but it's a judgment by a regulator who's got to make a decision during the fog of war. This is looking at UK banks, but it's pretty much the same story, that they all meet the capital ratio requirements.
Yeah.
US banks, now this number has moved around more than I realized over the past year or so, having fallen from almost 16% to about 13.5%, but still well capitalized on that basis. So given what's happened to Credit Suisse, i.e. the regulator has said, well, we don't need to look at the actual technical trigger, because there's another part of the documentation that says we could make our own decision based on what we think is happening in the market. People have become a lot more nervous about what risks they're really taking with the AT1s. So the cost of them is going to increase because investors are not going to trust what they thought they had bought isn't actually what they bought.
Yeah, and this chart basically shows how much of a bank's capital structure is AT1. So how much banks will need to either replace their AT1s, or actually, well, they could just not call them and just keep going with the ones they've got.
Yep, in which case we'll have another one of these tensions between technically what the documents say versus the market practice. So here we've got another measure of sensitivity. So if AT1s, if their cost increased by 100 basis points, what would that mean in terms of hit to underlying profit before tax? So if AT1s went up by 1%, Barclays profits would be down by about 2%. UBS is next on this list, also the same sort of order of magnitude.
Yeah, not huge.
No, that all seems totally bearable, isn't it? I think the issue will be more whether there's a buyer's strike because people are not interested to hold this anymore. It is possible as a private punter to speculate on this stuff if you fancy it. Here is the Wisdom Tree AT1 Cocoa Bond ETF, US dollar hedged, which has fallen from a peak last summer of about 114 down to about 82. So definitely an opportunity there if you're being contrarian. And there is reason to be contrarian because the various non-Swiss authorities have said that they will take a view which is that equity has to be wiped out before AT1s because they've been shocked at what the Swiss authorities did. But it's always a complex situation. As we were talking about before, if the Swiss thought that an actual wipeout of equity would have led to a bankruptcy, a technical bankruptcy of Credit Suisse, and therefore possibly the invalidation or the chaos caused in trillions of dollars worth of derivatives, it could be that despite the BOE and the Fed saying they would try to respect traditional capital structures, that during a future crisis, they may be faced with the same problem, the same trade-off. And I think the lesson of this is almost a bit like Maastricht rules on government debt. Authorities will do what they've got to do to get through a situation, irrespective of what you think that the technical situation should be.
Yes,
there's always political risk, legal risk. Things can be twisted and have been.
Yeah. On the this Cocoa Bond Fund, I mean, I think it's too early. Referring back to that my chart of how I think things will play out, you want to wait until the second crisis is over and the blood is on the streets before buying this. I think the risks are more to the downside than the upside at the moment.
Right. Yes, this is just what we've been covering. The Bank of England statement about creditor hierarchy, where basically they're trying to reassure investors that no, these AT1s, that they are fine, that don't worry, you can be assured that you'll be treated better than Credit Suisse investors were. Maybe true, they may intend it, but during a crisis and a panic, they're going to do what's necessary to preserve the overall system. And that might mean shooting AT1 holders, who knows? Yes, very good, Keith, very good. So in summary, AT1s are somewhere between equities and bonds in the bank capital structure. I would say that they're presented as equity to regulators and they're presented as bonds to investors, so everyone gets to see what they need to see. The Swiss liquidation of Credit Suisse AT1 ahead of the equities is supposedly anomalous, and regulators have indicated that they won't be following the same pattern. You can speculate in this stuff if you want. There are some ETFs available, and if you've got a strong stomach and you want to go for it, have a look at some ETFs.
So while we talk about financial crisis, a quick section on Softbank. Now, you know that Softbank is this huge Japanese fund that invests in technology and cutting edge technology and was spraying money around to any technology firm that would accept it. So it funded WeWork, etc., and vastly inflated valuations. Now, what's interesting is the founder, so Masayoshi Son, borrowed money from SoftBank to invest in the second Vision Fund, and he currently owes SoftBank around 4.7 billion, and that loan is secured on his own shares in SoftBank. The Vision Fund is losing money. In Q4, it lost 5.5 billion as tech company valuations fell. For example, WeWork is in trouble and is having to restructure its debts. Now, in May, SoftBank will report its Q1 earnings, and there are likely to be further losses, although actually the Nasdaq's recovered a bit recently. But the bottom line is that there is a doomsday scenario here where if the share price of Softbank falls below a certain point, then he no longer has the security against the loan, and the loan gets called in. His shares then have to be sold to repay Softbank. So he gets wiped out, but also those shares need to be sold in the market, leading to a meltdown in Softbank.
Yes, it's one of these cases of what could possibly go wrong. It's so incestuous. It's sort of leverage on leverage in effect, and you're going to get these amplifying effects. It's just awful.
Yeah. So the trigger point, apparently, the point to watch, and we'll try and keep a tab on this going forwards, is shares in Softbank going below 4,300 yen. And they are well down from their peak. He's got a little bit of headroom, but sustained falls below 4,300 could lead to meltdown. Something to watch.
Because I think Elon Musk has done a similar thing, hasn't he? Pledging his Tesla shares. Though I believe that the trigger points for him is wildly less than even the current reduced share price. Whereas this, you look at the chart, 4,300. There's not much margin there, is there?
No, and that triggers. He bought 4.7 billion. I mean, one man. Onto other charts, Stuart.
Right. The declines in housing that we talked about in the US shows very few signs of abating and appears to be reasonably common across the world at the moment. I think we've been highlighting before the issue with the Australian housing market and the Swedish. I'd also be interested to see that the Dutch, given that lovely chart that you produced last year about the long-term mean reversion of Amsterdam house prices. But yeah, mind your head, and it's falling. All those big bubble areas are unwinding: New Zealand, Canada, Sweden, etc. Here's an absolutely shocking chart. I know the FT has got a much more in-depth article about this issue, which they produced today. But this is US life expectancy, which is continuing to decline. It's so different from the rest of the OECD. Now, obviously, there's a COVID impact as well, but even if you ignore that, US life expectancy has been lagging other comparable countries. And as I say, today, the FT has got a very in-depth study of this, and it's really talking about a lot of deaths between the ages of 5 and 40, which you wouldn't have expected otherwise. So perhaps this is the famous deaths of despair, gunshot deaths, road accident deaths, etc. It's really quite a shocking outcome for the world's sort of most powerful country.
Yeah, the world's richest country as well.
Having a look at China now, the great hope for this year is that the Chinese reopening will support the world economy. And on this measure, it is doing exactly that. Data is beating expectations by really rather a lot. However, if you are hoping to benefit from that resurgent economy by investing in the Chinese or Hong Kong stock markets, you've been rather disappointed. And I think the issue here really is how much can you trust ownership and property rights? I think it's totally weighing on, in particular, well, but both of those measures, because of the centralization of power and the issue that's been raised across numerous industries where the Communist Party wades in and tells you what you can and can't do. The credit impulse in China does, however, appear to be somewhat weak. So the beating of overall expectations of Chinese economic statistics that we looked at 2 slides ago might be a function really of low expectations.
Yeah. Now, I thought this was really interesting, actually, because normally the Chinese react by pumping the economy full of funds for an investment. And actually, they're being quite circumspect.
So this presumably is they don't want to be building more bridges to nowhere and excess infrastructure investment. Is that the idea?
Yeah. Okay, thank you, Stuart. On to good news. And I like this. So this is the roof, I think it's of a Toyota Prius, and you can now buy solar roof panels. And it's not going to make a huge difference, but a roof panel like this can power the average car for about 776 miles, which saves around 14 gallons of petrol. And that means it would take 13 years to pay for itself. But the price of solar panels continues to fall. And this would seem like quite a sensible thing to do, particularly if you live in Saudi Arabia or somewhere.
That's great, isn't it? I mean, if your car is like mine, i.e. a motorized shopping trolley, and basically just sort of you poodle around the corner, pick up the shopping and come back, then, perhaps the solar panels will do most of the work.
Yeah. And on to equity, Stuart.
All right. Well, a pretty good week for risk assets. The all share up 1.5%, Stocks Europe up 2%, S&P 500 up 2.7%. The Nasdaq actually slightly lagging that over the past week, but year to date is up almost 15% compared to the S&P being up 5.5%. A bit less action in the Far East. The Hang Seng up 2.7% year to date. Topics up 5%. Very quiet week for Bitcoin, down just 0.5%. Basically, no news there, but up 70% on the year. Bit of action in currencies. The pound has strengthened a little against the dollar, up just under 1%, as has the euro, pretty much the same. And the VIX, rather weak, down at just 19, which in Keith's little schema means that the S&P 500 is a sell on technical measures, and we know he thinks it's a sell on fundamentals too.
Yeah, so actually, in line with this strategy, I have reopened my spread bet.
Good.
£1 a point, a bit of fun.
Not too much market impact.
Yeah, well, we will see. Sell below 20, so the market is getting a bit carried away with itself. Volatility has collapsed, which is a sell signal. So, I made a bit of money on it last time, enough for a decent bottle of wine. So,
Good stuff. Oh my goodness. Right. Okay. So this is looking at the constituents which have driven the increase in the S&P 500 market cap year to date. And there's a clear story here where it's all in the top stocks, the biggest stocks, the tech stocks. They've added 1.8 trillion to S&P 500 market cap. The rest of the market has done nothing. Investors are sitting in cash. Well, obviously, we know this is also impacted by the banking crisis. This is not necessarily investment money. This could be deposit money. So money market funds, 5.1 trillion, up from about 4.5 a year ago. The weekly inflows into money market funds, very strong, as we have been talking about. And just to reiterate the point that we covered last week, yes, money market funds offer you a higher return. That's great, good reason to hold them. But also because you're holding a security which is custodied outside, it's custodied separately. So your ownership, your security on it is stronger than if you have a deposit at a bank, or in particular, if you have a deposit at a broker. Global equity valuations, blended PEs here, blends of trailing and forward PEs and Schiller PEs. And this is a very clear story of the US being much more highly valued than the rest of the world, both emerging market and developed market ex-US, trading on much lower valuations than the US. And that actually is a chart that explains my own investment allocation, which I covered last week, which is that I maintain some equity exposure because I don't have the confidence in making big cyclical calls. But my equity exposure is pretty much this, is the world ex-US. Looking not just at PEs, but dividend yields, well, it's the same story. US dividend yield about 1.75%, whereas emerging markets about 3.6%, and developed market ex-US about 3.5%. So very clear valuation differences, which historically have been justified based on the higher growth rates of US companies, which has sort of been true, but you've got to believe that that's going to continue for the next 10, 15 years to make up for those valuation differences. And if you believe that the next 10, 15 years is likely to be a bit more old economy, a bit more to do with, say, mining companies and not tech companies, then I think there's a strong argument for tilting away from the US. And now there's a really strong disconnect between economic forecasts and earnings forecasts, where, as we've been covering in previous slides, GDP forecasts are actually weakening, and yet earnings forecasts are not. So basically, what gives can both be true. And I think most of us would be skeptical of earnings forecasts, particularly if they're the bottom-up earnings forecasts from stockbrokers, analysts who tend to sort of see things their company's way. I think perhaps the top-down earnings forecasts or generated from a top-down perspective tend to be a bit more accurate because they're prepared to accept that bad things can happen.
Yeah, no, this is a really important chart. And, I think we are all expecting earnings to miss expectations, which has bad implications for the stock market. Okay, thanks, Stuart. On to commodities and energy commodities. And it was a good week for oil, which bounced back. Brent up 4.5%, WTI up 6.3%. Natural gas in Europe has stopped falling, although down 40-odd% since the start of the year, which is all good news. In the US, natural gas prices are continuing to drift off, down 53% on the year. Coal drifting off, down 55% on the year. Uranium flat. Now, numbers specific to the oil market. Well, we are seeing another big inventory draw in the US. So having had builds for the first few weeks of the year, we're now seeing large draws, and that should be bullish for the oil price. US crude production actually fell by 100,000 barrels per day last week. And the Baker Hughes rig count recovered slightly, up 4. Now, this is crude, and reminder that we have seen inflation cumulatively over the last couple of years, the best part of 20%. Now, this is not inflation adjusted, it's just the nominal price of crude. And so, actually, it's fallen more than this headline number would suggest. Oil has become a lot cheaper. Drilling activity in the shale patch is slowing and is just about zero year on year because the oil price has fallen, but there's been significant cost inflation eroding the profitability of shale oil drillers. Now, we know that oil production growth is very heavily dependent on continued growth from the US. And if this is accurate, then that suggests growth will be slowing. And expectations for year-end oil prices have been falling. So these are European natural gas futures, well down from their peaks earlier in the year, but still a lot higher than pre-pandemic and pre-invasion. Same is true for the UK. US natural gas futures are really collapsing. They're back towards their decade lows. And this chart shows the expectation for US electricity production by source over the coming decades. And it starts in 2022, where renewables are actually already a decent portion of US electrical power generation. But over the next decade, renewables are going to expand enormously. And what gets taken out of the energy mix are coal and natural gas. And that would be bearish for natural gas, whose prices are already towards decade lows. However, energy consumption overall is expected to rise. And so natural gas consumption will increase slightly over the period. And LNG exports are hitting an all-time high, and we know there are more LNG export terminals being built, but most of those will start to come online next year rather than this year. This coal price, well down from its peak, very much mirroring the natural gas price, and uranium. Stuart, industrial commodities.
Well, here we go. Some activity here. Aluminium up 2.4% on the week. Cobalt 2.2%. Copper, where we know there's obviously the long-term bull case due to lack of investment in supply, are off this week by 0.7%, but up on the year by 7%. No real change in chromium. Iron ore up 1.6% on the week, 7% on the year. Bit more action in lithium carbonate, which I think that was the big bull story last year. Well, it's all come crashing to earth this year, down 54% on the year, following a 14% fall on the week. Neodymium off 4% on the week, 27% for the year. Nickel, however, up 6.5%. Perhaps people are demanding real nickel now and not any more rocks in storage facilities. Bounce for tin as well, up 10% on the week. Ferrovanadium off 2.5% and zinc up about 1%. So looking at that in chart form, well, no real direction for aluminium, bouncing around there. Cobalt has taken a big step change down, about $35,000 a ton. Copper showing some strength from the back end of last year and into this year. And this is global copper stockpiles and some indications that the long predicted shortage of copper might be coming within the tangible time of the future. So some forecasts from Goldman Sachs here suggesting that visible inventories will run out over the summer.
Yeah. The alternative explanation for the lack of inventories, visible inventories, is that because interest rates have risen, so the cost of holding inventories has also risen. And so you'd rationally try to minimize your inventories. And so perhaps the fall in inventory levels is not a sinister effect of the fact we're just running out of copper. It's the fact that people are rationally holding less inventory.
Right, makes sense. Yeah. Right, so we're going to need a lot of copper for the energy transition, which I think we've covered in previous episodes many times. So we've got here a nice graphic. The total copper produced over the course of human history is the left-hand cube, and the total copper needed to reach net zero by 2050 is the right-hand cube. And that's all measured as against the size of World Trade Center. A lot of copper is needed.
Yeah.
Here's a chart of chromium, not really going anywhere. Iron ore had a big bounce recently, but has just come off a little. Lithium, yeah, this is the, we're going to run out of lithium story last year, has completely reversed this year. There's much more to be found. It's not too difficult, and the price has more than halved. Neodymium, also a big step change down there. Goodness, how many zeros are on that price? That's
yeah.
Nickel, well, be interesting to get Richard's view. To my uneducated eye, that looks like a long-term uptrend there, that it's bounced off the bottom. That not investment advice. don't follow me. Tin having a bit of a bounce. Ferrovanadium, no story really, I would say. Zinc has fallen quite a bit this year, $3,500 to $3,000 a ton. And moving on to precious metals, it's been a good year for gold, up about 9%, but not a good week. It's come off the top. I think it just about breached $2,000 an ounce, didn't it? And that's fallen back from that. Silver, however, has bounced on the week, up 3%. Not too much action in platinum or rhodium, but palladium up just about 2% on the week.
Yeah, big reversal from previous weeks. So the monetary metal gold has done badly as fears of the financial crisis have faded a bit, and the more industrial ones have had a bounce.
So here's gold reaching that 2,000 barrier, perhaps. It's been the one thing sort of protecting my portfolio over the past few weeks. So yeah, swings and roundabouts, zigs and zags, as it's fallen off this week. Some of my other positions have bounced back a bit. Diversification appears to be working. Bullish gold bets have been soaring amid the turmoil, and this is reflected in the options market, with a massive increase in the volume of call options being traded on the Spider Gold Trust. Futures positioning, however, doesn't seem to be excessively bullish, well within its usual range of long position. If anything, it seems weaker than average to me. Silver has bounced back a bit here, quite strongly, I would say. Platinum going nowhere, no real story. Rhodium, oh goodness, that looks a bit ugly, doesn't it?
Yeah, well, as catalytic converters, as the transition to EVs accelerates, then rhodium, I think, goes back to its historic price.
Yesterday's story, yep. Palladium, similar sort of picture.
Okay, thanks, Stuart. And finally, on to rates. Well, having fallen sharply over the last couple of weeks on fears of financial crisis and the Fed having to cut rates sharply, well, rates bounced back a bit last week. So the UK 1 year rose by 20 basis points. What's interesting is at the very long end, they fell, which was against my expectations. In Europe, we also had rises. So the Greek 10-year rose by 33 basis points, the Italian by 16, the Spanish by 15. But no sign of a recurrence of the Eurozone crisis as yet. Now, what I find interesting and reassuring is that speculative positioning in bonds has been and continues to be hugely negative. And whenever there is a crowded trade, that is generally a very bad sign, because those bets need to be unwound. And as they're short, that means they need to buy them back, which is bullish for bonds. And we've talked previously about how sanctions on Russia, where the US has essentially frozen their treasury holdings, has undermined the attractiveness of holding your reserves in the form of US treasuries. And this is China's holdings of US treasuries. And they've basically been selling them down over the course of the last decade and switching to holding gold. And the Fed has stated that it wants to get to positive interest rates. So interest rates higher than inflation by the end of this cycle, and they've achieved it. So Fed funds rate of 4.75% is higher than core PCE inflation, which is the Fed's preferred inflation measure, but only just. And the market is expecting cuts in the Fed funds rate by June or July. I just can't see it. I think the market is getting overexcited. And market is expecting a cut in the Fed's rate of up to 1% by the end of this year, when the Fed itself has stated it expects rates to be above 5%, i.e. still rising by the end of this year. One of the two is wrong. Okay, this is the UK 2-year. It's down from earlier in the month and pre-Credit Suisse, but now seems to have found a level. UK 10-year rising again, 30-year flat. This is the US 10-year, again down from earlier in the month, but now no longer falling. German bond yields rising again, as the Italian and Greek. Okay, Stuart, any changes to your asset views?
No, I was on last week. My views are not going to change that quickly. So just to reiterate, I've still got some equity exposure, but it's world X US, and I've got some short-term, short-duration bonds, basically as a sort of form of cash.
Yeah, we had a comment this week actually about cash, holding cash, and talking about how holding cash long term is a bad thing because it fails to keep up with inflation. Well, Spider786 on the Discord was pointing out actually the opportunity cost of holding cash is relative to other assets. And if you're expecting those assets to fall, such as equities, then, cash has a relative positive return if equities do indeed fall. And over the last year, they have fallen. But, the NASDAQ is recovering a bit at the moment.
Yes, I've also heard cash described as the world's cheapest option.
Yeah. Well, that is very much my view. People always underestimate the optionality of cash. Equities are very volatile. And if you want to take advantage of that volatility, you need cash to buy. Okay, so concluding comments. Well, the markets had a bounce. Equity markets have had a bounce this week as the fallout from the financial crisis looks to be contained. But the underlying stresses remain. And I'm expecting a kind of grinding crisis in the US small and medium banks as the commercial real estate, etc., loans get refinanced and come due over the course of the summer, and deposit flight continues. But equity markets can't stay in a state of panic for prolonged periods unless there's a continued flow of bad news. And right now, there isn't that continued flow of bad news allowing them to recover. The big thing is that equity and bond markets are forecasting very different things. The bond market is forecasting a cuts in interest rates and a recession in the second half of the year. Equity markets are forecasting that everything's going to be fine and anticipating higher earnings in the second half. They both can't be right. Stuart, any updates from you this week?
No, I totally sat on my hands, completely the same positioning as last week. No action whatsoever.
Okay, well, I had actually a much better week than I anticipated. I was expecting to have quite a bad week, but I was up 1.7%. The all share was up 1.5%, so I actually did better than the all share, much against expectations. But I was busy this week because on Monday, so last weekend, I was putting together the piece on the financial crisis, and I just thought this market's got carried away. There is actually very little evidence so far that the problems in the financial sector are leading to a credit crunch. The market is anticipating strong falls in interest rates, and bond prices have risen quite sharply. And I thought, well, actually, all the evidence we've been covering in previous weeks shows that the economy has been quite resilient. And I therefore cut my bet on long duration bonds, taking about a third of it off and realizing some losses. I'm going to go on holiday for a couple of weeks, and I didn't want to be taking that much risk. But
well done, Keith, for taking losses. It's not always easy, and I think you're very good at making your decisions based on what you think is going to happen in the future, rather than basing it on your book cost and book profits. It's not an easy thing to do, but so well done.
Yeah, well, it's never much fun. And I put it all in essentially the 2024 index-linked gilt, which is a cash proxy, essentially. So you're going to get inflation over the course of the next year. And we know that RPI in February was 1.2% in that month alone. And so if you hold TR24 for the month of May, over the course of the month of May, you'll make 1.2% tax-free. And this is where I am really in the portfolio. I still believe that the forecast is correct, that inflation is going to come down. We're going to have an economic slowdown, which will cause the central bank to cut interest rates, which will be good for bonds. But I've been way too early, and it's now just stomaching the volatility. So earlier we talked about how the Court of International Arbitration had ruled against Turkey and in favor of Iraq. And that means that oil companies that produce in Kurdistan are unable to export their oil. Now, this is the share price of Genel Energy, and this is the share price of Gulf Keystone. Now, both of them have come out with emollient statements saying that the Kurdistan regional government and the Iraqi government are talking and they don't expect their oil production to be disrupted for that long, and they expect the two parties to come to a settlement. The Norwegian oil company DNO have shut in their oil fields because they'd filled up storage and are unable to export, and so had no choice but to close the fields. My own view is that the Iraqi central government had been taking no share of the Kurdistan regional government's oil exports. It now holds the whip hand. And I don't think this dispute will be resolved very quickly, because the Iraqi central government has all the cards. It won't allow oil exports unless it takes a cut. And so all the production agreements between the oil companies and the Kurdistan regional governments could be ripped up and renegotiated. This could last for a long time. The share price of all these oil companies have not fallen this much. I would be very much sitting on the sidelines expecting them to fall a lot further. Now, talking about my bond trade, the trigger was when the 1 year yield falls below Fed funds, and it's decisively below that. But I think the bond market is anticipating a stronger slowdown than I think there is evidence for at the moment, and hence, despite that, I've actually cut my position. But the reason I'm up on the week is, having cut some of my index-linked gilt positions, it actually rose. So goes to show how much I know. Whereas the conventional gilt didn't. What's going on there? So the markets continue to mystify. Anyway, thank you for watching through to the end. Please can you press like and subscribe to the channel. I will be on holiday in Crete for the next couple of weeks, but let's see how we get on. If there's a recurrence of the financial crisis, I will be attempting to record again. So we may be on a break for a bit, but I may also do some short pieces. In the meantime, it is goodbye from Stuart Owen.
And it's goodbye from Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only, and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website, or to any information, products, services, or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.